In this video we are going to talk about dividend stocks with a high yield. So before starting this video, please like this video and subscribe to this channel for our future updates. Are you looking for a long-term investment that will generate a consistent income? Stocks with a high dividend yield can be a wise investment. Shareholders of dividend-paying companies get a regular distribution of a percentage of the firm's earnings from the company. Most dividend stocks in the United States pay investors a fixed sum each quarter, and the best of them increase their payouts over time, allowing investors to accumulate an income stream similar to that of an annuity. In addition, if an investor does not require a stream of income, they might choose to reinvest dividends. For investors seeking to create income, high-yield dividend stocks are one of the most prevalent sources of income. However, they are particularly crucial in difficult times such as the present. Pfizer. In terms of revenue, Pfizer, PFE, $43.96, is one of the world's top pharmaceutical companies, with annual revenues over $40 billion. The company once supplied a wide range of healthcare products and chemicals, but prescription medications and vaccines now account for the vast majority of its revenues, according to its website. PFE boasts 8 blockbuster drugs in its portfolio, including the cancer therapy Ibrance, the cardiovascular treatment Eliquis, and the immunology drug Xeljanz. PFE also has a strong pipeline of products in development. PFE has been reduced in size as a result of its joint venture with GlaxoSmithKline, GSK, and the merger of its Upjohn unit with Mylan. The company now has a more varied portfolio of innovative pharmaceuticals and vaccines. As a result, sales growth should be able to accelerate. Sales of major medications Ibrance, Inlyta, and Eliquis are expected to expand at a rapid pace, according to the company. Additionally, its COVID-19 vaccine has emerged as a significant contributor to the company's top line. PFE also has a strong pipeline, which includes a number of late-stage products that have the potential to fuel future growth. The company's recent launch of the cardiovascular medicine Vyndaqel has the potential to be a game-changer in the field of rare diseases. The company now has a good dividend yield of 3.6%, which is very attractive. Furthermore, PFE is the only one of the high-yield dividend companies highlighted on this page to have received an overall grade of A. According to the POWR ratings methodology, this converts into a strong buy. Because of its potential for growth, Pfizer has received an A growth rating. For example, analysts anticipate that revenues will increase by 62.7% year-over-year in the current quarter, and that earnings will increase by 36.1%. Earnings and sales are expected to increase by 67% and 74%, respectively, over the previous year, according to forecasts. PFE also has a quality grade of B, which reflects the company's strong fundamentals. For example, the company has a current ratio of 1.5, which shows that it has more than enough liquidity to meet its short-term liabilities and responsibilities. Pfizer also has a low debt-to-equity ratio of 0.6, which indicates that it is financially sound. Walgreens Boots Alliance. Walgreens Boots Alliance, WBA, $46.83, was founded by merging Walgreens and Alliance Boots, and it now has over 21,000 outlets throughout 50 states and 11 countries. It also has the world's largest pharmaceutical wholesaler and distribution network, with over 390 distribution facilities annually distributing to over 230,000 pharmacies, doctors, health centers, and hospitals. As part of the Health Hub, WBA also introduced Boots Online Doctor, a new service that connects physicians and patients online. In addition, in collaboration with VillageMD, the firm is speeding up the deployment of its full-service primary care clinics, making WBA the only national drugstore to offer physician-led primary care clinics. The overall grade for Walgreens, which returns 4.1%, is B, which is a buy rating in the POWR rating system. This is a bargain when it comes to high-yield dividend stocks. WBA has a value grade of B, indicating that it is undervalued based on many valuation factors. Its trailing price-to-earnings (PE) ratio, for example, is 18.1 and its forward PE ratio is 9.4. Walgreens also received a B for stability, indicating that the company has demonstrated consistent growth and price performance. Gilead Sciences. Gilead Sciences, Gild, $68.35, is a pharmaceutical company that discovers and sells treatments for life-threatening infectious diseases. The firm specializes in HIV/AIDS, as well as hepatitis B and C. While Gild is best known for its HIV medications, it also develops treatments for liver and blood ailments, cancer, inflammation, and respiratory illnesses. The Food and Drug Administration, FDA, gave the company full approval to use Veklury, remdesivir, to treat COVID-19 patients in October. Gilead's sales of the medicine totaled $2.8 billion last year. Furthermore, Gild's HIV and hepatitis C portfolios can create strong profit margins because these treatments only require a small sales force and low-cost manufacturing. Several single-tablet HIV therapies are available from the company. Genvoya and Biktarvy, the company's next-generation HIV treatments, are also helping it gain market share. Through acquisitions, the company is expanding its drug portfolio beyond HIV and hepatitis. In fact, it is refocusing on oncology, as Trodelvy, a breast cancer and urothelial cancer medication, has a lot of room for indication extension. Abbvie. Abbvie, ABBV, $115.45, is a pharmaceutical business with a strong immunology and cancer focus. Humira, the company's main medicine, generates roughly 37% of ABBV's overall sales. In May 2020, Abbvie purchased Botox maker Allergan, which changed the company's portfolio by reducing its reliance on Humira, its flagship medicine. Imbruvica, a blockbuster cancer medication, and Skyrizi and Rinvoq, two novel immunology treatments, put the company in a strong position for long-term growth. So far, the two immunology medications have performed significantly better than expected. Imbruvica and another cancer medicine, Venclexta, have both had their labels expanded by Abbvie. In addition, the company has a robust late-stage pipeline with a number of candidates with blockbuster potential. Humira, on the other hand, continues to be a revenue generator. The medicine is currently approved in the United States for 10 indications, and sales have regularly climbed due to strong demand patterns. The dermatological and gastrointestinal segments are witnessing particularly strong local growth for the medicine. Abbvie not only belongs to the Dividend aristocrats, but it also has an excellent yield of 4.5%. In the POWR rating system, it receives an overall grade of B, or a buy rating. The company has a B value grade, which is understandable given the stock's low projected PE of 9.2. The price-to-sales ratio of Abbvie is also lower than the industry average, at 3.8. GlaxoSmithKline. GlaxoSmithKline, GSK, $40.24, is one of the largest pharmaceutical companies in terms of total sales. The company's expertise spans a variety of therapeutic areas, including respiratory, cancer, and antiviral therapies, as well as vaccines and consumer healthcare goods. Joint ventures are also used by Gild to obtain greater scale in some areas, such as HIV and consumer products. Sales are being driven by GSK's new and specialty goods, such as Nucala, Trelegy Ellipta, Shingrix, and Juluca, which are making up for a drop in established medications due to generics. Several additional drug extension approvals are expected this year, indicating that the business has made tremendous progress in its pipeline. This should assist in increasing revenue. The company's presence in numerous geographic areas may also aid its bottom line. Expansion into markets such as Japan, for example, should create additional growth potential. GSK has also made inroads in emerging markets by acquiring product portfolios from companies like Bristol-Myers Squibb, BMY. The company received an A in the value component of the evaluation. It has a forward price-to-earnings ratio of 14.3, which is less than 15, and a price-to-sales ratio of 2.2, which is low. GSK also has a stability grade of B, which indicates that the company has a track record of consistent growth and pricing performance. Because of this, its beta is only 0.54, which suggests that it is only around half the amount of volatility as the larger market. GSK, with a yield of 5.4%, is the highest yielding dividend company on a percentage basis among the high-yield dividend companies featured. In the POWR rating system, it receives AB overall. This corresponds to a buy recommendation. What do you think of our video? Let me know in the comments section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.